Hey everyone, ready for another deep dive? We got a request to take a closer look at some dividend stocks and two companies in particular that were flagged as quote unquote no-brainer picks. Always makes me a little suspicious when I hear that,
Yeah, I can understand that. No-brainer might be a bit strong.
Yeah.
But dividend stocks in general, I mean, they're definitely worth exploring, especially, when things are kind of uncertain in the market. They can provide some nice, steady income.
For sure. For sure. And it's interesting, this article, it even name drops Warren Buffett and how well that strategy has worked for Berkshire Hathaway, which I think even if you're like brand new to investing, you've probably at least heard that name, right?
Oh, yeah, definitely. I mean, Buffett's a legend. Even he would probably say, though, don't just jump into anything. You got to do your research. But his track record with dividend stocks, I mean, it definitely says something.
Yeah. Always good to remember there's no real shortcuts to success in investing. So let's jump in. First up, we've got Ally Financial. Now, they're an all-digital bank, which already makes them kind of unique. And this article highlights their crazy customer growth. Like, they've been adding retail deposit customers for something like 62 quarters in a row.
Wow.
That's over 15 years.
That's a pretty amazing run. It really shows their model's working. Ally actually started out focusing on auto loans stemming from their history with General Motors. That's still a big part of their business.
Okay, so they've got that solid foundation, but the article also mentions that their stock, it took a bit of a dip recently because of some higher than expected loan defaults. I'm wondering, are these rising interest rates we keep hearing about playing a role there?
Oh, absolutely. Rising rates, they definitely lead to more defaults across the board.
Yeah.
I mean, borrowing just gets more expensive, and that puts a strain on people's budgets.
Makes sense. And when we talk about Ally specifically, I mean, how much of a concern is it that they're so focused on this auto loan market? Is this a sign of bigger problems, or is it just a temporary bump in the road?
That's a really important point. I think, yeah, their exposure to auto loans, it does present a certain level of risk. I'd want to dig a little deeper, What percentage of loans are actually defaulting? How does that compare to, Ally's own history and what's typical in the industry? These are the questions you got to ask.
Yeah, those are excellent points. It sounds like we need to go beyond just calling their stocks super cheap, which is how this article describes it. They do mention some appealing numbers like a low PE ratio and price to book value, but could you give us a quick refresher on what those actually tell us?
Sure. The PE ratio, that's price to earnings, basically compares the stock price to the company's earnings per share. A lower PE, which Ally has right now, can mean the stock is undervalued. Then you've got price to book, which compares the market price to the company's net asset value, what its assets are worth. Again, if that's low, like it is with Ally, it might be a sign that it's a good time to buy.
Okay, starting to get the picture. So even with this whole loan default thing, Ally might still be worth considering, especially with that 3.2% dividend yield they're offering.
Yeah, potentially. But remember, it's just one piece of the puzzle. A high dividend yield can be tempting, but we got to look at the whole picture, right? You need to see how much debt they have, what their strategy is beyond just auto loans, and how they're handling this whole changing economic landscape.
For sure, for sure. Lots more to uncover there. Now, this next company, Realty Income, this one immediately caught my eye because they pay dividends monthly. You don't see that every day.
No, you don't. That's pretty unusual.
Yeah, so it definitely grabs your attention.
That's for sure.
But before we get too excited about that, are there any potential downsides to those frequent payouts? Anything we should be aware of?
That's a really good question. And, before we even get into that, I think it's worth just clarifying what a REIT is, for anyone who might not be familiar with the term.
Yeah, that's a good point. Not everyone's a real estate whiz.
Right. So REIT stands for Real Estate Investment Trust. It's basically a company that owns and manages properties that generate income, like office buildings or shopping centers. And they're set up to distribute a big chunk of their profits as dividends.
Okay, makes sense. And Realty Income, they've got a seriously impressive track record. 653 consecutive months of dividend payouts. And they've been increasing those dividends for over 25 years straight. Plus, the article mentions they have some big-name tenants like Walmart and Lowe's. But even with all that, I'm curious, are there any risks tied to their business model, especially in today's kind of unpredictable world?
Yeah, their consistency is definitely impressive. And, they focus on essential businesses, things like grocery stores, drugstores, the things people need no matter what. That strategy helps them keep those occupancy rates high, even when times are tough, because people still need those essential goods.
Right. So even if we hit a recession, those businesses are more likely to keep paying rent, which means Realty Income can keep those dividends flowing.
Exactly. But like any REIT, they're not totally immune to the economy shifting. Rising interest rates, for example, can definitely affect how profitable they are. That's where we got to dive into their financials, look at their debt levels, and see how well they're managing those, especially with rates going up.
Yeah, that makes total sense. The article makes it sound like this dip in REIT prices, including Realty Income, is a screaming buying opportunity. But I'm starting to realize we need more context to figure out if that's really true.
You got it. It's never as simple as a headline makes it seem. Before we jump in, we need to look at their choices of properties, how they're handling debt, and their overall strategy, to see if they can handle these potential headwinds.
Okay, this is already super interesting. We've got two companies, both playing the dividend game, but with really different approaches and potential risks. As we start digging into their financials, what should we really zero in on? What are some of the red flags or green lights we should be looking for?
Great question. There are a few key areas I always focus on, especially with REITs like Realty Income. First, we got to understand their debt structure. How much debt are they carrying? What are the interest rates on that debt? And how might those rates be affected by the current environment where rates are going up? Because remember, higher interest expenses, they eat into profits, and that could impact their ability to maintain those nice dividends.
Got it. Debt structure, definitely on the list. What else?
Next, we got to analyze their portfolio properties. We know they focus on essential businesses. But what's the breakdown? What types of properties do they own? Are those sectors doing well, or are they struggling? We also need to look at the lease terms. Are they long-term, providing stable income? Or are they shorter-term, which creates more uncertainty?
Wow, I'm seeing there's so much more to this than I initially thought. So beyond just the numbers, are there other factors that we should be considering?
Absolutely. One crucial element, especially for a company with such a long history of dividend payouts like Realty Income, is management quality. We need to assess their track record. Have they made smart acquisitions? Do they have a clear and sustainable strategy? Are they transparent in their communication with investors?
Great point. So we're looking for a combination of financial strength, a solid portfolio of properties, and a capable management team. That's a lot to unpack.
It is, but it gives us a much clearer picture of what to look for and helps us evaluate their long-term prospects.
This is incredibly helpful. I feel like I'm finally getting a grasp on how to analyze REITs. Now, what about Ally? They're a bank, not a REIT, so I imagine our focus will shift a bit as we examine their financials.
You got it. With banks, we're going to look at a different set of metrics. Remember, their core business is lending money, so we really need to understand their loan portfolio and the overall quality of their assets.
Right, and we talked about their exposure to auto loans and those concerns about defaults increasing. What are some key metrics we can use to really assess how healthy their loan portfolio is?
One that I always look at is the net charge-off rate. This basically tells you what percentage of loans they've had to write off as uncollectible. If that number is rising, it could be a sign that the quality of their loans is going downhill.
Okay, so we want to see that number stay low and stable, ideally lower than the average for other banks.
Exactly. It suggests they're making good lending decisions and managing risk well.
What else should we be looking at when we're analyzing a bank's financials?
Another important one is their efficiency ratio, which we touched on earlier. This measures their non-interest expenses as a percentage of their revenue. A lower efficiency ratio means they're keeping costs under control and running a tight ship.
So basically, a bank with a lower efficiency ratio is making more profit from each dollar of revenue they bring in.
Exactly. And in banking, where competition is fierce and margins can be thin, that efficiency can make a real difference.
Got it. Efficiency is key for banks. Anything else?
Their return on equity, or ROE, is also worth looking at. It measures how well they're using shareholder capital to make profits. Generally, a higher ROE means a more profitable and efficient bank.
So we're hoping to see a strong ROE, ideally better than the average for similar banks.
Right. It suggests they're using their capital effectively and generating good returns for their shareholders.
This is all incredibly insightful. I'm feeling much more confident in my ability to analyze these companies and make smart decisions. But before we move on, I want to circle back to something you mentioned earlier, the importance of considering our own investment goals and risk tolerance. How do we apply that to Realty Income and Ally specifically?
That's a great point. It's not just about the numbers. It's about finding investments that fit with your overall financial plan and how comfortable you are with risk.
Okay, so how would you assess the risk profiles of Realty Income and Ally?
Well, Realty Income, with their focus on essential businesses and that long history of dividend payouts, is generally considered a lower risk investment. Their properties tend to be more resilient during economic downturns, and those consistent dividends provide a steady stream of income.
Right, those essential businesses are less likely to be affected by recessions or big economic swings. What about Ally?
Ally, because they're a bank with a lot of exposure to the auto loan market, carries a higher risk profile. The auto industry is cyclical and can be pretty sensitive to changes in the economy. And as we've talked about, rising interest rates can impact their profitability and how their loans perform.
So Ally would be a better fit for an investor who's okay with more risk and potential ups and downs in exchange for the possibility of bigger returns.
Exactly. It all comes down to finding the right balance between risk and reward that aligns with your personal investment goals and how much risk you're comfortable with.
This has been incredibly helpful. I'm starting to see these companies not just as potential dividend payers, but as complex businesses operating in dynamic industries.
That's what makes investing so fascinating. It's not just about chasing returns. It's about understanding the companies, the industries, and all the factors that influence their performance.
I'm ready to dive deeper into those financial statements and apply everything we've learned today.
Me too. The more we understand, the better equipped we'll be to make those informed decisions. Okay, so let's actually get into those financial statements now. I've got Realty Income's reports pulled up here. And remember, they're a REIT, so we're going to be zeroing in on some specific metrics for that type of company.
All right, I'm ready to put on my REIT analyst hat. Where should we start with all these numbers?
One of the first things I like to look at is their funds from operations, or FFO. It's a key profitability metric for REITs. It gives us a clearer picture of their operating cash flow than just looking at traditional net income.
FFO, got it. But why is that so important specifically for REITs?
Good question. REITs, they have a lot of depreciation and amortization expenses because of all the real estate they own. And those are non-cash expenses, so they can kind of make the net income number look a little misleading. FFO gives you a more accurate view of how much cash they're actually generating.
Okay, that makes sense.
Right.
So what are we looking for in their FFO?
Ideally, you want to see that FFO growing steadily over time. It shows they're managing their properties well and generating more and more cash flow from their operations. We also want to compare their FFO to how much they're paying out in dividends. A healthy REIT should be making enough FFO to comfortably cover those dividends.
Right, because if they're not generating enough cash to pay those dividends, that could be a red flag.
Exactly. It could mean they're stretching themselves too thin or maybe even relying on debt to keep those payouts going, which wouldn't be sustainable in the long run.
Got it. FFO and dividend coverage are definitely top priorities. What else should we be scrutinizing in their financials?
Occupancy rate is another big one. We talked about it earlier, but it's worth emphasizing. A high occupancy rate means there's strong demand for their properties and gives them a solid base for that rental income.
Right, because empty properties don't bring in any money, and that could affect their ability to pay those dividends we're interested in.
Exactly. So we want to see a consistently high occupancy rate,
Mm-hmm.
ideally above 90%. And we want to understand any changes or trends over time. Are they losing tenants? Are they having trouble filling empty spaces? Those could be warning signs.
Okay, occupancy rate noted. Anything else?
We always have to look at debt levels, especially with interest rates rising like they are now. We want to see a manageable amount of debt and understand the terms of their loans. Are they fixed rate, which gives them some protection from rising rates? Or are they variable rate, which means their interest expenses could go up?
Right, because those higher interest expenses can eat into their profits, and that could make it harder to maintain or even grow those dividends.
Exactly. We're looking for a REIT that's being responsible with its debt and has a solid financial foundation to handle whatever the economy throws at them.
Okay, so we've got FFO, dividend coverage, occupancy rate, and debt levels on our checklist. That's quite a bit to keep in mind.
It is, but it's all part of getting a complete picture of the REIT's financial health. And remember, these are just the starting points. We'll need to look closer at their individual properties' lease terms and the decisions their management team is making to really assess their long-term prospects.
This is super helpful. I feel like I'm finally getting a handle on how to analyze REITs. Now, what about Ally? Since they're a bank, not a REIT, I imagine our focus will shift a bit when we look at their financials.
For sure. With banks, we'll be looking at a different set of metrics. Their core business is lending money. So understanding their loan portfolio and how good their assets are is really important.
Right. We talked about their focus on auto loans and the concerns about defaults rising. What are some key things we can look at to gauge the health of their loan portfolio?
One metric I always look at is the net charge-off rate. Basically tells you what percentage of loans they've had to write off because they don't think they'll ever collect on them. If that rate's going up, it could be a sign that the quality of their loans is getting worse.
So we want to see a nice low and stable net charge-off rate, preferably lower than the average for other banks.
Exactly. It tells you they're making smart lending decisions and managing risk well.
What else is important when we're looking at a bank's financial picture?
Their efficiency ratio is another key one. We talked about this a little earlier. It basically measures how much they're spending on things like salaries and operations as a percentage of their revenue. A lower efficiency ratio means they're controlling costs well and running a lean operation.
So a bank with a lower efficiency ratio is squeezing more profit out of each dollar they bring in.
You got it. And in the banking industry, where competition is tough and profit margins can be thin, being efficient is a big advantage.
Got it. Efficiency matters for banks. Anything else?
We should also check out their return on equity, or ROE. This shows us how well they're using the money invested by shareholders to generate profits. A higher ROE generally means they're a more profitable and efficient bank.
So we want to see a strong ROE, ideally higher than what other similar banks are achieving.
Right. It tells you they're putting their capital to good use and generating solid returns for those shareholders.
This is all so insightful. I'm feeling way more confident about analyzing these companies and making informed decisions. But before we move on, I want to touch on something you mentioned before about considering our own investment goals and how much risk we're comfortable with. How does that apply to Realty Income and Ally?
That's a crucial point. It's not just about the numbers. It's about finding investments that fit with your overall financial plan and your comfort level with risk.
Okay, so how would you size up the risk of Realty Income versus Ally?
Well, Realty Income, with their focus on essential businesses and that long history of paying dividends, they're generally considered a lower risk investment. Their properties tend to hold up better during economic downturns, and those consistent dividends provide a nice, steady stream of income.
Right, those essential businesses are less likely to be affected by recessions or economic ups and downs.
Yeah.
What about Ally?
Ally, because they're a bank and so tied to the auto loan market, they carry a higher risk profile. The auto industry goes through cycles and can be really sensitive to changes in the economy. And like we talked about, rising interest rates can affect their profitability and how well their loans perform.
So Ally would be a better choice for someone who's okay with more risk and potential volatility in exchange for maybe getting bigger returns.
Exactly. It's all about finding that sweet spot between risk and reward that matches your own investment goals and how much risk you're comfortable with.
This has been so helpful. I'm really starting to see these companies not just as potential dividend payers, but as complex businesses operating in dynamic industries.
That's what makes investing so interesting. It's not just about chasing returns. It's about understanding the companies, their industries, and all the things that affect how they perform.
Okay, I'm ready to dive into those financial statements and put everything we've learned to work.
Let's do it. The more we understand, the better decisions we can make.
I'm really starting to see the bigger picture here, you know.
That's what it's all about.
Instead of just jumping on those so-called no-brainer picks, we're really taking a strategic and informed approach.
Exactly. And that's how you build a portfolio that's going to be successful and resilient in the long run.
And you know what's really interesting? It's like our deep dive, it's gone beyond just these two companies.
How so?
Well, we've actually developed like a framework for analyzing any dividend stock. We've talked about those key metrics for REITs like Realty Income and all the things to consider when you're looking at a bank like Ally.
You're absolutely right. We've given ourselves the tools to evaluate any dividend-paying company out there, no matter what industry they're in.
And that's a huge takeaway for our listeners too, don't you think?
Absolutely. It's all about empowering yourself to make those smart investment decisions that line up with your own personal goals and how much risk you're comfortable with.
This makes me think back to something we touched on before, the whole idea of research and due diligence. It's easy to get caught up in those headlines and hot stock tips, but that's not usually how you find long-term success.
Couldn't agree more. Thorough research. It's the foundation of smart investing. It's about digging deeper, understanding the company's financials, the industry, in their management team, their overall strategy.
And it's not a one-and-done thing either.
Right?
Nope.
The investment world's always changing. There's new information coming out. Companies are adapting, markets are shifting. So you got to stay informed and reevaluate your investments as you go.
This has been such an eye-opening conversation for me. I feel like I've leveled up my investing game big time.
That's awesome to hear. And remember, this is just the start. There's always something new to learn and explore in the world of investing.
So for all our listeners out there, what are some of the key takeaways they should remember from our deep dive into dividend stocks?
Well, first things first, there's no such thing as a risk-free guaranteed investment. Thorough research is absolutely crucial.
Agreed. You've got to understand the company, its industry, its financials, and its strategy before you put your money in.
And don't forget about your own personal goals and risk tolerance. What are you hoping to achieve with these investments? How much risk are you willing to take on?
Yeah, those are important questions. The answers will help guide you to the right types of investments.
And lastly, don't be afraid to ask questions. Challenge assumptions and get different perspectives. The more informed you are, the better you'll be able to navigate the markets.
So well put. It's all about taking control of your financial future.
Exactly. And remember, investing is a journey. Enjoy the process of learning and discovering, and be open to those new possibilities.
This has been such an insightful and engaging conversation. Thank you so much for sharing your expertise with us and for walking us through this deep dive into the world of dividend stocks.
It's been my pleasure. And to all our listeners out there, keep exploring. The investment world is vast and fascinating, and there are so many opportunities for those who are willing to learn and grow.
Couldn't have said it better myself. And with that, I think it's time to wrap up our deep dive for today. We've covered a lot of ground, from the basics of dividend stocks to the importance of research and making sure your investments match your own goals.
It's been a great journey. Hopefully our listeners are feeling empowered and inspired to take charge of their financial well-being.
Absolutely. So to everyone who tuned in, thanks for joining us on this deep dive. Remember, knowledge is power. And with the right information and some effort, you can build a portfolio that not only helps you grow your wealth, but also reflects what's important to you and helps you achieve your financial dreams. Until next time, happy investing.